let's talk about mortgages. So a mortgage is just a loan in which real estate is serving as the collateral for the loan, right? So you decide that you want to purchase a home, for example, right? So you put the home up, the real estate, as collateral to the lender, right? And who's the lender? Well, the lender could be a bank, it could be a credit union, it could be a savings and loan. There are even some companies that basically they specialize in originating mortgages, right? So you've got this lender, and you want to borrow the money to buy the home, but you don't have the cash, and they say, well, hey, what do I do if you don't pay me back? What recourse does this lender have? And you say, you know what? Well, I will give you the home as collateral for the loan. So if I don't make my payments, you can come and take the home, right? Because it was serving as collateral for this loan. It's like security to the lender to make sure that you keep up with your payments on this property. And it doesn't have to be a home. It could also be a commercial building or something like that. So I think it'd be good to just kind of walk through a little bit of an example. Let's say that you decide that you want to purchase a home. And again, it doesn't have to be a house, but let's just say that you decide, so this is you over here. You are the buyer. You're on the market for a home. And then this is the seller, right? So this is a person selling their home. This is the home that you want. It's your dream home. You decided that you want to buy this home. And this seller says, I'd like $100,000, right? So you don't have $100,000. So you go to a lender, right? You go to, let's just say this is a bank. Doesn't have to be, but in this case, let's say it's a bank. And you say, hey, I would like $100,000 so that I can buy this house, right? So the bank is going to say, okay, well, they're going to look at things like your income. They'll look at your credit score. They're going to evaluate how likely they think it is that you are going to make payments on this house to them, right? Are you going to make the payments to them, and are you credit worthy? So assuming that they decide, you know what, I do think you're credit worthy, we're going to give you the cash, right? So they're going to give you cash, right? And you have to give, and let me just, I'll use a few colors here so we don't get, so you need to give $100,000 cash to the seller, right? And what you want to get back is you want to own the home, right? And we'll call that's title to the home, or you want the deed for the home, right? Right. So basically, you want ownership, right? So there's a title, just like cars have titles, so do homes. So you want this seller to give you title to the home, and then you're going to give them $100,000 cash. But so when you go to the bank, one thing to think about is like typically with a mortgage, the bank is not going to give you $100,000 cash, even though that's what you need. You're going to have what's called a down payment, right? So let's say that the down payment is going to be, let's say 20% of the home's value, right? Now, why wouldn't the bank just give you the full $100,000, right? Why are they asking you for 20%? Well, the thing is, what if the bank were to give you the $100,000 to buy the home and you never made a single payment? Well, then now the bank has to do what's called foreclose on the home, basically get you out of the home, and then they're going to take that title, right? So they're going to take title to the home, and then they have to sell it, right? But it's a $100,000 home, right? And they're going to have to pay a broker to sell it, right? They're going to have fees for that. Like it's not easy for them to sell this home. It's not costless. It's not free. So they're saying, well, you know what? We don't want to give you the whole $100,000 in case you never pay us. We'll give you 80%, right? So we'll give you 80%. You pay the other 20%. And that way, if you never make a single payment, well, they give you $80,000 for a $100,000 home, right? So now they've got some they can foreclose, and they're not going to lose their shirt, so to speak. So the bank is going to give you cash. Now, it depends on what down payment you negotiate, but let's say in this case it was 20%. So the bank's going to give you cash of $80,000, right? Now, in exchange for that, right? So now the bank is giving you this money, right? The bank's giving you that money. You're taking some of your own money and the bank's money, giving it to the seller, right? And then the seller is giving you title to the home. However, that title That title is subject to the mortgage. Let me change the color. We'll go with green again. Subject to the mortgage. That means that you can't just turn around and do whatever with with the house, turn around, sell it again or something, because you have a mortgage on it, right? You have a lien on this property. You have to make all your payments to the bank before you own that home free and clear, right? So now what are you doing in exchange for the bank? So now what color should we'll go with orange. So now the bank gave you the $80,000. We got to give the bank something back. So you're going to give the bank payments, right? And that's called your mortgage payment. And it's almost always it's a monthly payment, right? So when you have your mortgage payment, your mortgage payment is going to consist of multiple parts. Okay, so one part we'd have is the principal, right? The principal is the part that they loaned you, the $80,000, right? All that has to be paid back. But they're also going to charge you interest. Now, what interest rate you get depends on how creditworthy you are, depends on what the market rate of interest is at the time, how good you are at negotiating, and so what type of mortgage you select, right? So, but these are the main two components, but those aren't the only things that are necessarily going to be in the mortgage payment. Might also have other things, like, for example, the bank will force you to get homeowners insurance, right? And they'll just lump the payment for the homeowners insurance in with the mortgage. So the reason the bank wants homeowners insurance is, okay, well, what if this home burns down, right? This home is a $100,000 home, and they don't want some kind of situation, right? Obviously, if the home burned down, and you said, oh, well, sorry, I guess I can't pay you back that $80,000 or any of the interest. I don't have a home anymore, and what can I do? You can't take the home from me. So they say, well, we're going to force you to get insurance in case that happens. And then they're also going to make you do other things too, like, for example, when you own real estate, you have to pay property taxes, and so they might lump that in with the mortgage payment. So there's all these different things that go into the mortgage payment, and in determining what the mortgage payment is going to be, we not only have to think about things like interest, right, but there's also going to be what type of mortgage you get. And I'm going to talk about the different types of mortgages you can get in an upcoming